With this ETF, a simple one-time $10,000 investment given a 30-year time horizon and simply just reinvesting the dividends each and every year could grow your investment to approximately $168,000 and provide you a dividend income annually of just under $20,000 per year.
Oh my God, oh my God, oh my God!
Selecting an ETF is going to save you the headache of the process of trying to sort through and analyze thousands of company stocks. But believe it or not, just by searching dividend investing in ETFs, I found nearly 200 different ETFs that not only pay dividends, but specifically focus on a dividend investing strategy. That's how many choices you have. And it gets mind-boggling. The ETF that we're going to be looking at in today's video is the Schwab Dividend Equity Fund. And I'm going to explain why I do believe this is either the best or at least in the top 3 dividend-paying ETFs you can invest in. Good morning, everybody. My name is Mike the CPA, and welcome if you're brand new here to Money and Life TV. On this channel, I like to cover dividend investing, taxes, and other financial news topics. There's no doubt about it, inflation is here. And if you're like me, you're probably looking for ways to take your cash, which is losing value, and investing in something that can grow but also pay you an income. Please know that I am not a professional investor, but I have been dividend investing for quite some time now and have had some success. However, please always do your own research. Don't just straight up listen to somebody over YouTube. Always look at the investment itself and make sure it makes sense for you and your investment goals. One of the most attractive things about dividend investing is you don't have to wait till you're 60, 65, or 70 to try to retire. You can actually start building up your passive income right now using dividend paying ETFs, and you can track your dividend income every year so you know how close you'll be to your goal. Ticker symbol SCHD. It's considered the gold standard of dividend growth ETFs. SCHD passively tracks the Dow Jones U.S. Dividend 100 Index. It represents 100 high dividend paying U.S. companies with a record of consistently paying dividends selected for fundamental strength relative to their peers based on financial ratios. My wife and I have been tracking our dividend income every single year, and it's really fun. It's really motivating. So if you want to check out where we're at in our journey, you can check out this video right here. To meet the cut, the companies they select have to have 10 consecutive years of dividend payments. And note, it doesn't mean that they're growing their dividends consecutively, but 10 years worth of payments is what it says here. They have to have a minimum market cap of 500 million and an average daily trading volume of $2 million. Once those stocks are sorted out, then it really comes down to 4 fundamental metrics. Basically, total cash flow to total debt, 2, return of equity, 3, the dividend yield itself, and 4th, the 5-year dividend growth rate. In this portfolio, what you're going to find is there's a lot of turnover, meaning every quarter they're going to be looking at what stocks should be making up this ETF of the 100 stocks within it. So there's a 43% turnover ratio. So don't get used to the same companies always being part of this, because if those companies fail to meet the metrics that we just discussed above, they're going to get cut and maybe come back later. But just so you know, the best stocks or the best companies they deem for this ETF are being implemented on a quarterly basis. You'll see here no single stock can be more than 4% of the index, and no sector can represent more than 25% of the total index. So if you're looking for diversification, you got a good set of diversification here. The index rebalances at the end of March, June, September, and December after the quarterly dividend payment. On Yahoo Finance, you can check out some of their current top 10 holdings, which includes Home Depot, IBM, Pfizer, PepsiCo, Texas Instruments, Cisco Systems, Coca-Cola, Amgen, Broadcom Inc., BlackRock, etc. As we're going through this video, I want to hear from you. What do you think is the best dividend paying ETF? Drop that in the comments below and tell me why. At the time of filming this video, the average yield right now is around 2.81% on this particular ETF. Now, at first glance, you might be looking at that 2.8% yield and say, Mike, that's pretty low. But you have to realize that yield is growing year after year. So you can see here in 2016, for example, the yield grew by almost 10%. In 2017, the yield grew another 7%. In 2018, it grew 7%. 2019, it grew about 20%. In 2020, it grew about 17.64%. So you're investing in these shares of this ETF, and those same set of shares, year after year after year, you can expect them to pay you more and more money just for holding on to them. This ETF has actually been around since 2011, and you can see how each and every quarter, or each year I should say, you can see how their dividend continues to increase quarter after quarter, and all the way up to where we're at now, where it's paying anywhere from 50 to 60 cents per share at this moment in time. Like I mentioned earlier, there's hundreds of different ETFs that focus on dividends, which is why this one has competitors as well, as you can imagine. Some of which are from Vanguard, so we have DVY, you have VIG, VYM, which is another Vanguard fund, and then some of the S&P 500 or Spider shares, dividend-paying ETFs that are on the list. So let's look at performance now and see what kind of capital appreciation this thing yields on top of the annual dividend payout. Using Yahoo Finance, I ran a couple graphs. So SCHD is in the purple. This is year to date in 2000. This is as of June 18th of 2021. And you can see year to date, it's slightly underperforming SPYD. Now let's look at a longer time period and see how this performs. Over a 1 year time frame, you can see that SCHD is in the lead with, over the past year, it's returned 41%, not including the dividend. Not bad. Over a 5-year period, it is returned just under 86%, so it's just slightly below VIG. Using a dividend calculator from marketbeat.com, I was going to show you how this can grow for you. And this is just an example of a 5-year time horizon. But if you look towards the top of the page, you'll see that after 5 years, a simple one-time $10,000 investment can grow to over $14,000 in value, provide you with a total return of just under 45%. And at that point, you'll have an annual dividend income from this fund of about $530 a year. Simple as that. And that is because that 2.87% yield that we look at and we say that's kind of low. But when you compound that annual dividend growth rate on top of this, you can actually see that your yield grows rather quickly. And all of a sudden, your money starts working harder and harder for you. Same facts as the previous example, but now you have a 10-year time horizon. So your $10,000 investment, in this case, with reinvesting those dividends, grows to $21,724 if you're looking at the top of the screen, giving you an average annual return of 11% and a $1,000 annual dividend income after 10 years. If you're able to give yourself that 30-year time horizon, this can compound for you to the point at which you'll actually have an annual dividend income of around $20,000 a year from that one-time investment, and your account value from this investment could be as much as $185,000, assuming the same facts as in the previous examples. Quite amazing. Now, obviously, as you know, there's no guarantee you're going to get these exact results because there's so many variables that could change along the way, especially given a 30-year time horizon, but I think you get the idea. Of the investments we just looked at, I actually own SCHD, we own VIG, and we own SPDY. The reason I invest in multiple dividend-paying ETFs that are focused around dividends is because each one owns different stocks, or they have exposure to different areas of the market, which is why I have more than one. Now let's talk about some of the cons. We've talked about a lot of the pros of this investment. What could go wrong with this investment?
I'm sorry that people are so jealous of me, but I can't help it that I'm popular.
I think the first thing you have to watch out for with this ETF and what to expect is that it has a higher beta in terms of volatility, meaning if the market moves to the downside, this thing's going to move to the downside faster and harder than, let's say, an S&P 500 fund or something like that. It's just a little bit more volatile. You get the dividend yield, but the price fluctuations can be a little bit more extreme. If you're someone who is looking for REITs, real estate investment trust, you're not going to find it in this Schwab dividend ETF. Con number 3 is if you're looking for monthly income, you're not going to find it here because the payments are only on a quarterly basis. The fourth con is that the yield on this investment is a little low, of being under 3%. It's not the lowest, but it's also not going to make you rich overnight. And if you're somebody who's really needing income like right now, then I probably would not go towards this fund. However, if you have a long time horizon and you have time for those dividends to keep compounding and that yield to keep growing with that high dividend growth rate it offers, then I think this is a good option for you. But it's no covered call ETF, that's for sure. You're not going to get 7-8% yield on this thing. You're just not. So if you're looking for income right now, this is probably not the best choice. In summary, despite some of those cons, I do believe this is one of the best dividend paying focused ETFs in the market, especially when compared to its competitors. It has wonderful price appreciation. It has terrific compounding annual dividend growth rate that varies from like 10 to 20%. That yield you get, it's going to keep growing and growing year after year. And it has some of the best companies of the Dow Jones Industrial Index, but more so, Schwab carefully selects and filters out the companies that are not meeting its strict criteria, which is why Seeking Alpha, in my opinion, has given it the gold standard of ETFs. And I've invested in this fund. I have not been disappointed. It doesn't do everything. It's not going to give you those high yields like 6-7%. So, but it's going to give you a stable investment. And I think it's going to be one where you can count on that income for the long term. Now, in terms of the pricing, if the market really dives, the value of this fund is going to go down as well. There's no doubt about it. If the market tanks, the value of this fund is going to go down. But knowing that the companies are carefully screened and that only the companies that have paid dividends for 10 consecutive years are part of this, it's a good chance your income would still come in. So with all those factors being considered, I think this is a fantastic investment overall, and one I would really want you to take a look at and consider. Thank you everyone for watching. This is where I'm going to wrap up the video. Drop a like if you enjoyed this, subscribe to not miss our future uploads around dividend investing and other financial and tax related videos. Have a great week everybody, live life uncaged, and I'll see you all in the next episode. Peace.